Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow.
Yeah. All right, welcome to Market Call. This is Dan Nathan. I got Carter Braxton Worth here. It's 1 o'clock on the East Coast. Carter is in the studio with us. This is very exciting. We got a lot to do here. Guy Adami is out today. He's going to be back with me tomorrow. Carter, how you doing, man?
Well, he's busy. He's one of the biggest write-ins for president, isn't he?
He really is.
He's like campaigning.
Yeah. So there's Jill Stein,
Right.
there's RFK Jr., and then there's Guy Adami. You know, he could run for something, by the way. He should run for New York mayor. He would clean this place up in a heartbeat.
It needs a little cleaning.
No, it does need a little bit of cleaning. We got a busy week here. It's kind of one of those weeks, Carter, where it just feels like there's no stopping this sort of potential tape bombs. You know what I mean? And
a lot of earnings. I mean, it's still 1,000 names, 1,084 within Russell 3000. So one of the biggest weeks. Not big in terms of market cap. The big players are done with, but still big.
Really quickly, just for our viewer here, because you're on Fast Money with us all the time. You're on tonight, I think. You do this with us, but you also do all the work for Worth Charting, and you're going over hundreds, and obviously over the period of earnings, thousands of stocks, right?
Mm-hmm.
How do you decide what to focus on as far as market cap? I mean, obviously you have to hit the major names that are potential market moving, but how do you move down, you know what I mean, the market cap structure, and how important are some of those other names?
Well, the process is driven obviously by what most institutional clients are interested in. Most people are very large cap, right? So your typical portfolio manager at a state pension plan or a mutual fund or hedge fund says, look, it's got to have at least 8 to 10 billion in market cap. They're not interested in things that are 300-400 million because they just can't move in and out. And so the primary objective is to find large liquid names, because if you think about it, the greatest sin in markets is not being wrong. It's illiquidity. There's nothing wrong with being wrong. Just get the heck out. But if you're stuck in something that's illiquid, you got a big problem, as we all have.
Especially in earnings season, where some things can be sort of binary.
So just try to go through A to Z and try to identify those that are most interesting. And again, it is a judgment. It's very subjective, and you can get 10 in a row wrong or 10 in a row right, but it's interpretive. It is subjective, and it is a process that over years it's rules based. Well,
you and I have been doing this a long time. It feels like earnings season keeps getting longer and longer. The banks, I think, reported back there on October 12th. Here we are. It's November 4, right? 4. And we don't really, in my mind, we don't end until November 20th when Nvidia reports. We're going to hit that in a little bit here, but it just seems to be elongated, which is, really means you're going to have a lot more single stock volatility over 1 month every quarter.
Sure. And really small cap retailers report well later and so forth.
All right, let's throw the rundown up here. We got a lot to do. We're going to talk about just the way the market's been trading a little bit over the last few days. Obviously, Friday's jobs report caused even more jitters when we think about what's going to come on for the rest of this week. We're going to take a look at the markets through the lens of the futures, but Carter has some great charts looking at some of the cash charts there. And, there's certain sectors that have just been moving around. They got going, one way or another during this rate move that we've seen all over the place over the last month. And then we're going to take some questions. All right, let's start, Carter, with where we love to start. And this would be the S&P 500, the E-minis here. We drew a couple lines here. You can decide whether they're useful or not. You see that uptrend. We see your 150-day moving average. We see how far above it we are. I think this is probably at the highs last week, probably as far as we've been above the 150-day over the course of the last year. Whether that breakout level from about a month and a half ago is important or not, we're sitting right on it right now. You know what I mean?
Right. It's very important in the sense that the setup was the high of July 11th or thereabouts. The whole market swoons, makes that August 5th low, reverses hard, and makes a slight new high. But key aggregates have done the same thing, except for one thing: they never made the new high, right? So that mid-July high, the August swoon, and the recovery to and slightly above the high, that's not the case for the Philadelphia Semiconductor Index or the Eco Weight or the Qs, NASDAQ 100 and so forth. The Russell 2000 still well below its all-time high. So it's distinctly and uniquely the S&P 500. And the risk here, of course, is that we undercut. There's not any real support here. A prior day or two of trading doesn't represent support. There's I think at a minimum, one can expect volatility. That's obvious,
Yeah.
right? Obviously, the politics is what likely to drive that. And so it's a good time to hedge. Look, 99% of all people are long only all the
Yeah.
time, right? If you look at the short interest on the New York Stock Exchange going back 50 years, it always averages 1.5%, 2% at best, all in. And so does one embrace risk or pull back a little bit going into a known prospective highly volatile event? We don't know that it'll be volatile, but prospectively very high.
All right, I have a question for you on this chart here. So if we're going to look at this 150-day, which has been rising here, let's just get the exact number here. So I'm pulling it up right here. And maybe Amanda, let's go away from this chart. Let's do one without any lines. And I want you to draw a different trend line here for a second. I want to get your take, Carter, on this. So 57.50 was that high from July. We're sitting right on that, right?
Mm-hmm.
And so you just talked about why that's important, why that's not. We look at basically it's 5,500 is that 150-day. All right, let's draw a trend line from the August lows, attach it to the September lows, and we're right below that. And so I want to get your opinion, Carter. It's like so we're right below that. So that last trend line that we drew from a year ago, it didn't have too many touch points, right? Like, so maybe that didn't have a lot of authority, but to your eye, you can see bottom left, upper right, pretty much a 45-degree angle. This trend line versus the one we drew before, is this an important trend line to you?
Well, it's an intermediate trend line versus longer term, longer duration, more important. But you can see the three distinct breaks. There's the April break, there's the August break, and then the prospective break that's occurring now.
Yeah.
Right. So do you give back some of the gains or a lot of the gains associated with the move since the August 5th low? That's just normal behavior. What's unknown is when a minor or intermediate sell-off turns into something more severe. Right.
So if I was looking at this and I was looking to trade the futures and I said to myself, okay, what do we have? We have an election tomorrow. It might be volatile in and around that. We might not know the result. Actually, not knowing the result maybe could result in more volatility for all we know. We could see movements. We're going to take a look at the dollar. We're going to take a look at yields. This one's kind of interesting setup to me. Again, no one knows how the market is going to react. And then on the 7th, so on Thursday, we're going to get the Fed's rate decision. And if you go back to September and we think about just the uncertainty, whether it was going to be 25, whether it was going to be 50, how quickly expectations change for that. If I were to look and I wanted to put in some sort of hedge or directional, we're going to get that. Look at that. They're already putting up the questions here. I would probably stop a short in the futures here at that uptrend line. If we were going to kind of head back above that, maybe a little above 5,800, and I would be targeting a move back towards, I don't know, something that looks like that 150-day or so. If you're looking at that, that probably gives you about 4.5% from those recent highs. Does that make some sense?
Yeah. And the level to use as a stop, if and as it's wrong, of course, is the obvious thing, is a little bit higher than the prior high. But the problem with that, of course, is that everyone else knows that. Of course. And so they run things to a stop level. Do you go a little bit more? But then if you give yourself a little more on the upside for the stop, you've lost more. It's ever thus. There's no perfect answer to that.
Yeah. And a lot of it with trading futures also is certain points of your gut feel. You could be looking at other risk assets that might inform your view one way or another. But putting in a stop from the get-go makes a ton of sense. At least you have your mind around what sort of loss you're willing to take if you get it going the wrong way. All right, let's look at some charts that you brought. This would be the NASDAQ 100 versus the S&P 500 total return index. Some interesting stuff here. I know you did this work. It went out to your subscribers at Worth Charting earlier here. Talk to me about what you're seeing here.
Yeah, I just was trying to highlight the fact that the truth is the NASDAQ 100, the celebrated NASDAQ 100, with the marquee names that have driven so much results, really hasn't done any better than the S&P, which has got dogs in it dragging it down, from Walgreens Boots and impaired retailers and impaired banks and so forth and so on. And so a lot of autocorrelation, to be fair, between the blue line and the black line, because a lot of the constituents in the blue line impact the black line. But either way, it's always and ever thus about timeframes on a long-term basis, and we'll look at that next. This, of course, is a blowout in terms of one versus the other.
Yeah. Well, it's interesting you mentioned that, so the top 10 names are 50% essentially of the weight of the NDX and NASDAQ 100, about 30% of the weight of the S&P 500. And the more stocks that you have, the more distributed, I guess, some of the returns are going to be. You just mentioned some of these names that are really, not acting particularly well, but they don't have huge weights in the S&P.
Right. And also remember, if two things end up at the same place, having started the same place, one can say, well, they're the same thing, but they're not. Adjusted for risk, the blue line's much worse. On the bear market low of 2022 in October, the Nasdaq 100 was down 37%.
Yeah.
The S&P was down 27. So adjusted for beta risk, the black line is a much better return series.
Yeah. All right. Let's back this thing out a bit more here. You want to go back to 2007 and let's talk about where this kind of diverged and what you're seeing here.
Right. And we might have a table here just to, I don't know if we do, but
Yeah, we do.
Let's look at that first. So the short term, but this is going back. It just shows how incredible basically, and this is not new. Markets are built to go up. The GDP increases, the population generally increases, more Oreo cookies are consumed, more Gillette razors are used, and so forth and so on. And so it's why most people never want to be bearish. And it's why perma bears are sort of ridiculed. But, people who are perma bullish are just relying on history and they're never willing to take a chance about seeing something a little bit dark.
Yeah.
For what it's worth, and before we get to the chart, since data has been tracked going about 18 years, collectively, it's a Wall Street convention that's silly. Strategists are asked to predict, so stupid, why not 13 months versus 11? But because it's a comfort blanket, where will the market be 12 months hence? And as a group, never once has Wall Street called for a down year.
Yeah.
Imagine that, because no one wants to hear that. They're called sell-siders. They're selling wares. They're selling shares to the public, unloading shares in many instances. And so, and they also know the history. Things go up more than that, and you could see here. But what's incredible about the Nasdaq 100 is, of course, how much more volatile it is on the up years and the down years. So if we looked at a long-term chart, and that's what we've got next, obviously it's a blowout comparing the two on a long-term basis, whereas the past 2 years, they're even money.
Yeah. Let's go back to that table for a second here. And, I've talked about this a lot. Maybe I just have PTSD from it. I started in the business in 1997. I saw this massive NASDAQ bubble just inflate. People tried to kind of take shots of it popping. And, when it finally started to, a lot of people didn't think that was it either. You know what I mean? If you were one of these bulls and you just kind of bought all these themes in and around the internet. So when I think about the protracted bear market that we had in 2000, the S&P only closed down 9%, but the NASDAQ closed down 30%, right? And then by the end of it, at the lows in 2002, the S&P was down maybe 55%, but the NASDAQ had lost 80-some% of its value. And then it took 14 years, as you know, to get back towards those highs. Why is it now, if you just go back and look at since 07, right? In 08, we literally had the financial world as we know it almost come apart. And that was the only year the stock market was down. Then you flash forward to, basically COVID. We weren't even down we had a quick decline during COVID. We made it up and then just kept on going. Why is it that bear markets are so much shorter? Even if you go to 2022, that was kind of, I don't know, didn't feel that bad. It was kind of like orderly on the way down.
Well, if you think about a setback, a sickness, right? A sickness, it gets fixed. You try to, you have a broken something or really sick, you, barring death, right? You repair. And so the long-term trajectory is of health until obviously you die. But the point is that markets, these are not just numbers and columns. These are managers who are highly trained to try to continue to progress and prevail and make their businesses better. And over time, good operators generate more earnings and the share price reflects it. And so bear markets are short-lived, and that's the nature of bear markets. If you think about 87, how quick that was, they can last a year or two, but a real protracted bear market, we haven't had one of those in a while because basically the PEs are lowest during war. Real war, right? You get P's down to 4 and 5 because everything's on the table. You could, they could come across the channel and then you got a problem if you're in London. Point being, that's the final discount. But generally speaking, we have peace in the world, for lack of a better expression, right? And we know it's never peaceful, but peace in the world. They're in the United States, the leading lady, the leading light. They're generally productive earnings, unemployment is low, and so the markets are over time like that. Now the real question is what, and this is unknown, what ultimately kicks off something really dour, and Is it a spike in interest rates? Surely that would do it. Not 6, but it'd have to be 8 or 9. That would kill the whole thing. Or something, but looking for those things doesn't really work. You're like, well, I see war coming. There's always fear mongering, right? That's not a sort of a way to analyze it. The question is, there's 2 ways you go down. You go down because earnings falter, or you get multiple contraction. Same thing in reverse. Our markets can only go up one of 2 ways. You have to have earnings growth, or you have expansion in the multiple, or you get some combination of the 2. So looking out here, it's like why a lot of people say maybe we've got a lost years ahead. What is the thesis for truly expanding earnings from here? Earnings growth when it's been or multiple expansion. I mean, are we really going to have 38 times or 45?
So that's a great point. We're getting both right now, right? If you think
correct.
About it, so from the secular shift as it relates to generative AI, you've seen multiples expand because of the way that investors see the opportunity for them. But they're also, those companies are growing already. Now they're spending a lot more, right, to get that sort of growth and that positioning in that, in generative AI, but we'll see how that plays out. And then you also have a situation where we came into this year where consensus estimates for, EPS growth year over year was like 11%. It looks like we might hit that. And then next year, 14% expected earnings growth that has not been coming down so far.
Right.
You know what I mean? So that's the combination of the 2. All right. I jumped the rundown a little bit because you brought S&P charts, the cash, and you brought NASDAQ. And I already asked you where you think the S&P could go. But let's look at this chart because you drew a nice little line. To my eye, I was just eyeballing it. I thought 5,500 was the level also.
Sure. So this is going back, 10 years. And well, if one didn't know what it was, that's always the mission. One would say it looks okay, pretty healthy up and to the right, normal ascent with counter trend moves. And so one would say, why doubt that? The question, though, is how long can you go without some more give back, more of a reset? And that's always the issue, unknown. But maybe we have some short-term charts of the S&P. So this is the here and now. And again, when you're in uptrend, you do experience drawdowns. And so the question is where to? We have one with a chart line. We could flash the 150-day trend line, put them together, combine them. It's a pretty good level. And the unknown is, and this is the hardest part, one, do we have to go down there? Of course not. Maybe it's 6,000 post-election day. But if and as we are headed lower, the hardest thing to do is figure out what to do at 5,500. Do you press the bet? Go short more? Do you cover it and play for a bounce? All of a sudden it really comes apart. There is no good answer to that. It's a day-to-day kind of thing. And rather than watch the index, it's the behavior of key stocks, how they behave.
Yep. And we know what those names are.
That's
it's
right.
Obviously the way banks have been acting too. They become very important in the kind of volatile rate environment we have. All right, let's look at the NDX really quickly because, you just kind of outlined the outperformance over a long-term basis. But again, what we're trying to do right here is just kind of think about, okay, the way rates have been moving around. We have the Fed meeting, 2 days after the election. There's a lot of potential move. I think both you and I are saying, how do things kind of shake out in the near term? I'm going back to 2016. I remember right before the election, the stock market sold off. You're not going to believe people where the stock market was, the S&P 500. It was like 2,200 or something like that, which is crazy. Here we are at 5,720. And then once the election was done, it was kind of off to the races. Not too different than in 2020 because and there were some other things going on there. I think the COVID vaccine was announced, widely available like a week later after the election. Again, off to the races. So if we look at this sort of movement here, if you were to have a check back this week, then you have a resolved sort of Fed situation where you have some clarity about what the December meeting might be, and then you have some resolution to the election, and let's say you have mixed government, that sort of thing. I could see the market making new highs in the next month and a half ago, but I'd love to see a little fear put back into it.
Yeah, I mean, the inability to make the new high now is the question, right? It hasn't been able to get above its mid-July high. Unknowable. I'm betting that you get the volatility alone results in lower levels.
Yeah.
To the 150-day and prospectively then some.
All right. So the big question, and you've been calling for in a pretty healthy manner. And I think you kind of laid out your first view of yields. Let's just kind of go to the 10-year U.S. Treasury yield. When we got to 5%, I want to say a year ago or so, you thought, we were going down. We had that nice move. You took the yield move off. You kind of been selling rallies here. To my eye, Carter, you could kind of draw a line from that 5% level, connect it to, that other one. You have a nice, maybe
it's almost there.
Maybe you're going to do that.
Yeah.
Oh yeah, you are going to do that.
Yeah.
All right. So should I start looking at the rundown and seeing what's in there before I do that? All right. I'll let you do you.
The thing is, the higher for longer, and it's small print there, but that point at which we hit 434, right? Mm-hmm. It was in July of 2022, mm-hmm. and we basically surged from 2.4 to 4.3, mm-hmm. and that was the low for the market. The extrapolators, that's what you call them. It's like the average comprehenders. Mm-hmm. They just take what's going and say more will come. It means nothing. The extrapolators came up with the phrase higher for longer. It never happened. Do you know that not once did the 10-year yield close above 5%? Mm-hmm. Not once. Mm-hmm. And over the past,
it touched it though, right?
It touched it intraday for 1 second.
Yeah,
I mean, 5% is not higher.
I think that's a
low level
headline on our screens too. 10-year U.S. Treasury.
I mean, 5%. It's a low level of cost of money.
Yeah.
10-year money at 5%. Yeah, it's nirvana in principle, and the market has figured that out. That it's so Goldilocks. It's not quite. But the key is that we never once closed above 5. And over the past, since that peak at 4.34, where we are now, mm-hmm. of 115, 120 weeks, mm-hmm. it was only above 4.5 about 18 weeks. Yeah. This is not higher for longer. It's just nothing. I'm in the lower rates camp, remain that way. I just never bought into. And also, let's just say something there. There's another way to draw the lines. When you start hearing something that rhymes and they come up with like FANG and all this nonsense and .com, run for the hills. As soon as it becomes a popular adage or bromide or whatever word you choose, it's almost always just the absolute low. It's like the classic magazine cover, so forth and so on. So anyway, rates are, the cost of 10-year money is low.
Mm-hmm. Yeah. And again, this chart is pretty fascinating. You see it kind of getting narrower and narrower, and this would be a great level kind of for it to pull back. And so I see what you see. So commensurate with the move in yields higher, we've also had a move higher in the US dollar index. That's the Dixie here.
Almost identical.
Yeah. Walk me through this.
Yeah. So here too, it's, the main thing is it's always tempting to look up or left and say, oh, that's Spotify. Oh my gosh, that's Apple. Let me have a judgment. There's nothing to say. It's a pair of twos. It's just wandering around. It has the huge spike of 21, 22. It has the equally impressive collapse, right? And notice where the peak is. That's the 2022. That's the low in the market, mm-hmm. right? Dollar strength. S&P is down 27%. And basically we've been meandering into this setup where we are now. My hunch is it's not going to do anything.
So let me ask you, I think we talked about this a little bit. So strong dollar would normally mean weak gold, right? Like that's at least how a lot of folks who trade mm-hmm. macro think about it. So why is it that the dollar had this huge move and gold barely comes in at all?
Yeah. And so the bulls would say that just shows how much gold has room to run.
Yeah.
And of course, gold adjusted for inflation is nowhere near. And silver, my gosh, silver would have to triple or go to $85 an ounce adjusted for inflation to get right. to a new high. But the gold strength in the face of that kind of dollar strength does, in principle, one could say, well, that's how vulnerable it is. It's the opposite. That's how impressive gold
you love the relative strength.
Oh, sure. And then it's enduring under the face of that. It's yes, all the above.
Well, if you're in the lower rates camp, and they do come in a bit. I mean, this is off to the races with gold, and if the dollar comes in line with rates, maybe you could pull up, Amanda, like a 10-year. I just think it's interesting that the 150-day is basically 24.50. We're at 27.50. Mm-hmm. I mean, a check back to that uptrend, and then let's just say the 150 is almost there or so. That would be a sort of layup of a level, but that would be a huge sell-off in gold.
Yes, and silver, of course, is not kept up, and that's the real opportunity if one wants to play the beta trade. The interesting thing, of course, the gold miners, which is where the real beta is, are crushing the S&P year to date. The GDX probably up some 40%, mm-hmm. and it's just a small asset class, mm-hmm. right? And there's not a lot of big money in gold, frankly. If there's only one stock in the S&P, that's Newmont, and so people don't care about it. But what we do know is it has clearly separated itself from Bitcoin. Bitcoin has all the
Yeah, we're gonna
volatility.
hit that.
All
But let
the-
me ask you this.
yeah.
And normally,
I mean, it's extended. Sure.
yeah, well, I
Oh,
was
yeah,
going to say,
sure.
normally, if you saw this chart, you'd say unabated,
Right. Well, let's
parabolic
look at
move.
silver at the same
Okay.
time.
Yeah.
I don't know what we got. Is that gold itself? So
Yeah,
look at the
that's
silver
gold.
future. We'll see this, that it's just silver is basically, I think there's a catch-up trade. And
Yeah.
a lot of people spend time with the gold silver. It's nowhere near.
So it just broke out.
Yeah, it just
Yeah.
broke out. Exactly.
All right. So Guy Adami is probably, his ears are ringing a little bit on the gold. Let's look at the Bitcoin, which you just mentioned. This is a 1-year chart. It was interesting that the move earlier in the year where it just went parabolic, right? That was around the creation of lots of ETFs, okay, or the regulatory approval of them. And really, we just consolidated. I mean, it was like kind of series of lower highs and lower lows. But again, this was kind of one of those ones where, folks thought if Trump was going to win, you'd see, further deregulation of Bitcoin, but it's come off a little bit. Thoughts on this one? And maybe Amanda can get a longer term chart ready too.
I mean, ultimately, it's back to its high if you look at a 5-year, right, and it's contending with it. I suspect higher, and I've published on that in the same way. The pullback perfectly reasonable.
All right. So today, as far as the 10-year yield, we've seen, I don't know, 8-9 basis points, which is, not a huge move, especially the way it's been moving. But in normal circumstances, that would be kind of a big move. Let's pull up the XHB, the home builders here, because they came off an all-time high. There were some results out over the last few weeks, earnings results.
Kind of mixed. Some were good. Some
some were good. And some of them actually had big sell-offs. But again, the 30-year mortgage got as low as maybe 6.5, and now it's 7 or a little higher. Thoughts on home builders? Again, your 150 days seems to be a little bit of support over the last year. What are you thinking in this space?
Yeah, we recently did a video on why we think you should fade it. They feel a little bit stalled. But to be fair, it's a perfectly sort of reasonable thesis to say the chart is fine, stay the course.
All right, quickly, let's rip through Lennar. I mean, it looks the same, but
yeah,
Toll, this one's kind of interesting. All right, Toll Brothers on its earnings, you see that move there. It gapped lower and then closed at the high. And there's a big range there. Does that one, maybe you could toggle back and forth, does that one look different than Lennar in your opinion?
They're slightly. I mean, look at NVR, for instance, which is the big heavy one that's always the perennial outperformer, Nancy Victor Roger. That one hasn't checked back at all, whereas others are more impaired. XHB, of course, has bigger weightings in things like Home Depot versus ITB, which is more concentrated in the home builders proper. But either way, the case that I've been making that this is a fade is contrarian, right? Most people would say, for now, this is an intact chart. Stay the course.
Yeah, and again, the volatility in mortgage rates is probably not the sort of thing that home builders love. You know what I mean? Because you need to have some visibility, probably on rates, and that seems to be, who knows? I mean, the CME Fed Watch tool is pricing a 98% probability on Thursday's meeting that the Fed cuts 25 basis points, and then the December meeting, I think about 82%. But again, we know that the Fed funds rate, obviously, it's important, but 30-year mortgage is trading closer to what the 10-year is doing and the like, and that's been pretty volatile.
Right.
Here's another sector, Carter, that again, it was kind of like a Trump trade. I'm doing that in air quotes a little bit. Regional banks. A lot of folks thought that maybe there'd be like the foot off the neck of regulation and the like here. And this was one, I know that you liked it. You called for a breakout on it. I think you did it. I know you did it for Worth Charting Lines. I think you came on Fast Money and you were talking about, let's look at the KRE or the BKX. Let's start with the BKX. Actually, this was the call here. What a beautiful breakout, right? You see that consolidation got up to that level, and then it broke out. Do you like the price action here in the banks?
No, I'd harvest that. I'd fade that.
Yeah.
Sure.
And then if you were doing that, like, is that support level, which was prior resistance, is that an important level? If you got down there, are you
minor support? I mean, it's not a definitive and authoritative breakout. It's a slight pop above those very precise intermediate tops, and it has a bit of a stall to it. I mean, this is truthfully make no trade, right? I'd
Yeah.
say no bet. But if I were forced to, no, you must buy or sell. You must be long or short. I'd be small short.
Okay. And let's go to the KRE for a second. So the regional banks I kind of was just talking about there. That's just one of the thoughts that, again, from a regulatory standpoint, maybe they benefit under a Trump. What does that uptrend look like to you? It looks like they've kind of banged off it a few times here. Thoughts?
Yeah, I mean, obviously, a relative performance to the BKX continues to make new 52-week lows, and banks in general. If you look at the BKX relative to the S&P, it's below its financial crisis low of 2009. I mean, the whole thing's a mess. These are not, these are trading stocks. They are not things to own and hold. Obviously, one could say, what about JP Morgan? Okay, that's the exception that proves the rule.
Yeah.
Yeah.
It most definitely does. All right, this is one. I'm just going to throw you for a loop here. And I don't know if you get asked about it. I'd love to know actually how much you get asked by institutional clients, but you also have a lot of contact with retail because of your product that you send out to a lot of folks there. Let's look at Berkshire, the Class B here, because this is one that, no one knows exactly what's going on. They've kind of cut their bank. Well, not kind of. He cut his Bank of America stake in half. It looks like they keep selling Apple every time they have the opportunity to do so. Huge winner for them. What does this look like to you? And in a name like this, where the components of this business are so diverse, is it that useful to kind of look at something like this?
Yeah, I mean, you have to look at it as either the railroad and industrials, which is, or you have to look at it as an insurance company. But all of these things like See's candies, and that's all just nonsense. Okay, but they have no weighting in the thing, right? Yeah, good candy and so forth.
Expensive candy.
Yeah. The interesting thing, of course, is that there are people who believe in fundamentals as sum of the parts. Some people do discounted cash flow. Some people look at charts. Some people who are activists, they bet the jockey.
Yeah.
They study management and they say, this guy, this operator, this person. Tandy, which was Radio Shack, was a wallet company originally. They did leather wallets. Sometimes you can just find someone who is a fantastic operator and who can just change his stripes. And so the question is, ultimately, this has been the best operator of all time.
So I was in Pennsylvania driving in Bucks County the other day, and it was like a strip mall out there, and how they have the big signs in front of the strip malls in the parking lot, and there was a Radio Shack sign on there. They just haven't taken off. They're all gone.
They're all gone.
They're all gone, which is kind of fascinating.
It's fascinating. They're a big company at its peak. But the point is that this is obviously not a one-man show, and that's not what I'm saying. But the interesting thing is, I would buy the check back here. But the main thing I think that we all have to take away is that this was a man who was ridiculed at the dot-com peak.
Yeah.
Because
for not participating.
We know how that ended. And this is a man now who is being not ridiculed, but a little bit, well, come on, you have $320 billion in cash. You can't find anything to buy. Listen, I would say he's doing that for a reason, right? Yeah. And so,
well, he's 94 years old. He's thinking about succession. You think?
Well, here's the one that's a great mystery. There's not a lot of places that could soak up that kind of cash, right? 320. But guess what? They owned it for 20 years. They owned Costco. Charlie Munger was on the board.
Yeah.
And they sold it on the COVID spike, of course, because Costco did so well when everyone's rushing off to buy supplies. And that's now 4 or 5 years ago. And this is not me scolding them or saying they shouldn't have sold it, because Costco's done very well since. But wouldn't it be interesting if he were to return to something that he had for 20 years? That is truly, that's the ultimate SaaS model, isn't it? I mean, you pay those membership fees. Obviously, it's too expensive for him now, but one of his great winners, which he then saw a tremendous relative performance post-COVID, exited, just as now he's exiting Apple or holding all his cash. So,
well, it's funny, in raging bull markets, in things like tech, for instance, you mentioned like 25 years ago, I mean, people spend less time looking at a company like Berkshire, right? Like if you think about it, and we probably saw that over the last year or so.
Remember, he never split his stock. This B share thing is new because he didn't want sell-siders controlling, put a sell on it. So no one covered it because there was no banking fees. And so he was immune from the whole nonsense of Wall Street. Obviously, the B shares are for people to be able to buy because what are the A shares now? We've maybe looked that up, but I remember
the A's are 66. 66,000. I
was walking, visiting a friend at a brokerage firm. This is 20 years ago, and someone just through the hallway was pitching.
662,000.
Right. Right. So someone was pitching Berkshire, and the guy who didn't know anything, he was just looking at share price because most stocks are $40, $80. He goes, I think you missed this one. It's up a lot. Meaning That's because they never split.
I
Right?
love it. Well, until you kind of had fractional shares. I mean, but the B shares did that too. It's interesting. That one, for years, God, the guy's 94 years old, and, Charlie Munger passed recently, and, they're talking about succession, but you put a gun to my head. I couldn't tell you, who's taking over. I know a lot of folks who cover it.
Here's the other, how he handicaps things like hole-in-ones. He'll pay off for that if you get a hole-in-one in a golf tournament, or he does, esoteric insurance. I wonder what he himself would bet if he could do a post more. What would does the stock on the announcement of his death, does it go up or down? And a lot of people I've asked this over many years. A lot of people, it's 50-50. Half people say, well, down initially, but then it goes up. A lot of people say down a lot. Some people say, oh no, it'll be lunch. But I mean, it'll be interesting.
I feel like 10 years ago, people thought it gets murdered. You know what I mean?
Yeah. But I mean, then the bankers salivate because presumptively it all gets broken up. Fees are coming. But we'll see.
Let's hit a couple names before we get to some questions here. Really quickly, Nvidia, like I just mentioned earlier, November 20th, the confirmed date. We heard from some of their major customers. It's Meta, it's Microsoft, it's Amazon, it's Google. The CapEx was there. These are my lines, not yours. I guess I probably could have done away with a red one here, but you see that uptrend intermediate. It bounced off that 150-day. Thoughts here on this one. Again, it's kind of, got added to the Dow Friday afternoon. It's bucking the trend here. It's up, a little less than 2%. I don't know what indexing looks like for the Dow, but that's what's going on here, buying in front of the ad.
Yeah. So the interesting thing, of course, is it peaks a little bit before the market. It makes its same low on August 5th. It recovers and now has been underperforming the market. And that's the nature of all these sort of marquee names from Microsoft and Google and so forth. It's really, I would say, no trade. I mean, do you bet that it, after backing and filling, breaks out? Okay, reasonable. Do you bet that it's putting in a double top and it's faltering? Okay, reasonable. Meaning, it's not a clearly defined moment, and those are usually best left alone.
Yeah, no doubt. All right, let's look at one last name. This is Palantir, reports after the close. And what's interesting to me about this one, you see obviously that move, it's doubled since the August lows. It's up 140 some percent on the year. You see how steep that uptrend is. It just broke below it. You see that 150-day looking kind of lonely all the way down there. Implied move about 12% in either direction. Carter, this stock has moved 19% on average over the last 4 quarters. It's got expected to have $2.7 billion in sales this year, 3.4-ish next year. So it's growing 20% a year, but as a multiple to sales with a $93 billion market cap, it doesn't make any sense. And I made this point earlier on the Tape podcast with Liz and Danny. I mean, what the hell do they have to do to get this stock going higher? And, expectations are already really high. And I'm not asking you to comment on valuation or the fundamentals, but when you see a move like this in a single name that should not be trading at this valuation, I'm telling you that, not anyone else. It's literally a rounding error. If you think about the sort of revenues that an Apple or a Microsoft or a Google just reported, I mean, 2.7 billion on any of their metrics wouldn't have made too much of a difference on anything.
Yeah, I mean, it's just steep and uncorrected. It's a phrase that I learned from my teacher mentor, and I repeat it often. I mean, if we pulled this back a 2-year or 3-year chart, how far above trend is it? It's far, far above trend. That doesn't mean that's a guaranteed miss on the earnings, but I would, at a minimum, if long, most people are, I would sell calls, or buy a risk reversal, or just sitting blindly long thinking, oh, it'll be all right. That might work out. That doesn't seem prudent.
Well, it's funny. And again, I look at it through the lens of fundamentals. I like the kind of M&A thesis. While most of them don't happen, it's kind of a fun game to kind of play it. I mean, this stock was a great takeover candidate if you believed in this secular shift, if you believed in their end markets were only going to get bigger. But not here. No one can buy it for $93 billion because the deal comes at $120 billion. You know what I mean? It would be the biggest tech deal in the history of tech deals, and that's not happening.
Yeah, and there's something called price discovery from that low of August.
Yeah.
What isn't discount? The idea is that the market is forward-looking and the share price is discounting the future. You can't discount 2 years, even though Wall Street thinks you can. You can't discount 1 year. People have 1-year price targets. It's absurd. But you can, on an intermediate basis, discount 3 to 4, 4 to 5, 6, 5 months. And how much of what lies ahead has been discounted by this move from the August low? I would say most of it, if not all of it.
Yeah, and I asked that question because our good friend, a friend of the show here, Scott Rogers, he asked Palantir today or tomorrow, and you just said, well, I'd sell calls at the very least if you owned it. So the reason I brought up M&A and like the probably 2% likelihood that this company up here could ever get a bid is the idea of selling calls, and like you said, a risk reversal, selling out of the money calls, maybe using the proceeds to buy a downside put. That is a risk reversal. You could also call it a collar. I mean, could the stock go up? Maybe you sell the calls 10% out of the money or something like that. But because the implied move is about 12%. So that's the reason why I bring that up. All right, let's go to a question from, here it is, from, okay, this is the colorblind collector. I like that. Have CBW update XOM buy. Any thoughts on XOM?
So energy across the spectrum is very, very weak. Exxon is the sort of the safety name. If we pulled up a maybe do a 5-year chart or longer, you can see what, of course, is important here. It's the huge run up off the COVID low, and this equally huge or duration based rest or pause. More often than not, that is resolved by a higher price, and that's the bet, and that's what we published on.
Yeah, I like that. I know they reported on Friday, and the stock has kind of consolidated or came in a little bit from that nice breakout. To me, I'm with you as far as the technical setup, but I also think about what's going on with crude right now and OPEC pushing out, production. That should benefit maybe a little bit from the price here. All right, let's get a couple more in here really quickly. Let's look at this one from Wavy McFly. I'd love to know Dan and Carter's favorite cross trade, long and short, for a possible Harris win. Interesting. All right, let's think about that for a second. We don't have to just kind of pull it out of our what's here.
So cross trade meaning
pair? Like pair trade. Yeah.
Yeah.
The macro one's hard, and we kind of talked about that. And like, let's assume that.
Well, you mean MAGA like playing prison stocks and things like that?
Well, no, those things. I mean,
rates?
those were the thing. It's kind of the rates versus the dollar. You know what I mean? So like the dollar has come off a little bit. Like let's assume over the weekend the polls got really tight. Let's say it's a toss up, but there was a couple things that kind of gave Harris a little bit of momentum. You know what I mean? Let's just say she wins. Okay. Under that scenario, let's just say it's a definitive sort of win. I mean, I think this could break hard either way, by the way. You know what I mean?
Yeah. How's that feeling?
Yeah. So let's just say it breaks towards her. Let's say we don't know about the House. Let's say the Senate just stays flat here. Okay. Like 50-50. And then the vice president has, what's a trade? I mean, I said it before. I think the stock market probably goes up. I think it probably goes up in most scenarios, because if you think about her, they're going to spend more money. They're going to do the sorts of things that they want to do. On the flip side of that, if Trump were to win, they're going to extend those tax cuts, right? And then, I mean, either way, you're going to have deficit spending or higher deficits. That makes some sense to you, or no?
Yeah, I look, there's huge Wall Street firms with banks of analysts trying to, and they publish pieces on the baskets that will do well. And if you look at the history of that stuff, it's not particularly efficacious, right? It makes sense conceptually or intellectually, but how the chips play out or fall, as the expression is really less clear than the academic papers would suggest. I suppose the clearest thing would likely be banks in the event of it. Trump, when as was the case in 16.
Like you would like the banks, you're saying.
I'm saying that would be the most likely benefit. Yeah. But the interesting thing is that they only ran for about 4 to 6 weeks, and then their relative performance peaked on the last.
Well, so what I'd say, and I've been saying this on our pods and on Fast Money a little bit. I mean, to me, and I was kind of looking at this prior to their earnings. Let's just pull up a Morgan Stanley. Okay. Let's pull up a Goldman Sachs a little bit. I mean, beautiful breakout in Morgan Stanley, new all-time highs. Goldman looks really interesting to me. If Goldman were to check back just a little more, Carter, why am I saying the investment banks more than the money center banks? I think under either scenario, either win, I think this woman, Lena Khan, who runs the FTC, I think she's out. I think that Kamala Harris, she's courted Silicon Valley, she's courted big tech, and I think she probably had to kind of make some sort of assurance that the regulatory environment for big tech and for deals in general is going to look a little different. Let's go to the Goldman for a second here. So obviously Trump would definitely fire her, and I think you're going to see a lot more M&A. And so capital markets activity heating up should be really good for a Goldman and a Morgan, but the Morgan Stanley would have to check back a little bit for me. You know what I mean? I'm just curious what you think of these two, one versus the other.
Yeah, I mean, at this point, I would say Goldman's probably the better bet. It's been the longer term outperformer, but it's the these smaller little things. Pull up like an Evercore EVR just to show you how steep and uncorrected. These have been the ones that have anticipated really. And if you pulled this back, this is incredible. Do a 2 year or 3 year.
EVR looks almost exactly like on a 1 year basis Goldman,
right? But the Goldman Morgan Stanley don't like anything like this. These have been runaway, and it's also the private equity. So maybe keep ARES.
Oh man,
yeah. Ares, I mean this thing and KKR. This stuff is just through the roof, and so the question is that a relative outperformance? Look at that. I mean, these are exceptional performers. I suppose if things are really unleashed, these would continue to be outperformers.
All right, they're out of their minds.
All
right, listen, Carter Braxton, I appreciate you being here in the studio. It was a lot of fun here, man. We ripped through a lot of charts. And again, I've said this on so many occasions because Carter and I have the benefit of talking to him more than when we're just doing this and Fast Money. While you are a chartist extraordinaire, I think your insights about markets and sentiment and that stuff away from just looking at pictures and drawing lines on them are fascinating. I really appreciate it.
I'm grateful. I did start as a fundamental strategist, and I pivoted to charts after about 3 years. But sure, I have done that kind of work in the past.
Well, it's funny, and when I was on the buy side, every major shop had a technical analyst, a strategist, and it's amazing that most of them are kind of like sheep. They just follow some of the ones, and and there was a handful of them that that you grew up with who are still followed very widely as you are. And there's a lot who come and go, and not to say I love it. I mean, I learned fundamental stuff, I learned momentum, but charting and technical analysis was really important to me. I do have a fraction of the skill, when I say low single digits, of what you have, but it is an important input to me. And it's funny, it was all ridiculed when I started. I'll just give you a quick anecdote, and with this, that this teacher mentor, he said, if you go down this path, you'll speak last in the morning meeting. So, and he said half the salespeople will have left the room. And indeed, that's what happened. So everyone gathers at 6:45, and then the big Caterpillar analysts, we're upgrading Caterpillar to strong buy, or the Dell, we're downgrading, and the salesmen run off to go call their accounts, to go call the biggest mutual funds and the hedge funds to tell them we're upgrading this. And then at the end, okay, here comes the chart dude. And half the room is empty because no one respects it. Now it's all reversed. Mr. Simons, all he was ones and zeros. Yeah.
He's the greatest performer of all time. Now, that's fancy math pattern interpretation, but it's just patterns.
Yeah.
And now no one takes the advice of one expert to pick a restaurant. We use crowdsourcing. We use the input of many. And that's what charting is. It's the input of many to try to figure out the way forward.
Yeah.
But anyway, all good.
It's amazing, though, on CNBC, for instance, all day long, chart.
And they didn't have that.
Yeah, the visuals were.
And then not every newspaper has a chart, and they didn't used to have charts. And every report by mandate from the NASD and FINRA has to have a chart when you make a recognition. When before, a chart, a pictorial representative price. Yep.
All right, fair enough. All right, Carter Braxton, appreciate you being here. Guys, if you want to find his work in your email or your email box, you can go to workcharting.com. Check it out there. Great work. Look at that guy. He's a good looking man. Okay. We'll be back tomorrow. Guy Adami is going to be back with me. Looking forward to that. So thanks for everyone being here. And by the way, if you're watching this on YouTube right now and you do not subscribe to our YouTube channel, go hit that button, subscribe, share it, like it, whatever you want to do in there. That's how people find the show. Thanks so much, everyone. Thanks, Carter.
Bye.